Almost half a century since Peter Tosh sang. Now, as you may have heard, in much of the United States, it has been legalized.
And now to the growing acceptance of legalized marijuana across the country.
5 states legalized some form of it on Election Day.
In more parts of the U.S., weed is legal than it is not.
If it became law, cannabis sales would no longer be considered illegal, making the banking system accessible to the cannabis industry. While the bill's fate is uncertain, many in the industry are also encouraged by the growing number of states legalizing the drug and a democratically controlled Senate, whose majority leader has voiced support for broader legalization.
In state after state, through ballot initiatives and constitutional amendments, the American people are sending a clear message that they want this policy changed.
Coming up in today's review, stocks finish the week lower, consumer sentiment dips, commodity prices breaking out, and a big rip in cannabis shares on rumours of imminent rescheduling by the government. Hey, what's up guys? Welcome back to the daily review on what used to be known as Quadruple Witching Day. And that's because it's the third Friday of the month on the third month of the quarter. And the reason why it was called Quadruple Witching Day is because this is when stock options, stock index futures, and index futures options all expire. And up until 2020, we used to have single stock futures. And even though they were around for 20 years, they never really became a successful financial product. Volumes never took off in them and no one was just really trading them, so they kind of got all delisted in 2020, and that used to be the fourth product that used to expire on the third Friday of the month, the last month of the quarter. And so normally triple witching can bring a bit of volume and volatility, and we did get a little bit of that today. VIX actually finished up, which is unusual for a Friday. And we saw a bit of a sell-off led by tech names after we got that nasty earnings from Adobe yesterday after close. That spilled over into the broader software sector today, along with some falls in a few of the other mega cap tech stocks. Microsoft down 2%, Amazon down 2%, Airbnb and Booking.com both came off a bit today. And looking across the rest of the market, it was quite checkered breadth out there. There's a look at the weekly heat map, and checkered once again. Standout sector, energy, oil and gas, having a good week on the back of higher crude prices. Tesla having a bad week, breaking down technically. Microsoft still near all-time highs, and a bit of a pullback in the semiconductors, the hottest sector. And just switching over to the year-to-date performance heat map as we near the end of the first quarter of the year. So far, so good. Doing even better than expected election year seasonality, except for a few key names. Apple, still the second biggest stock on the market, down 10% year-to-date. And Tesla, really not having a good year, down 34%, as investor sentiment has changed on that name quite a bit. But Nvidia still well out in the lead there, up 77% year-to-date. And other areas of the market doing well too, with the banks up, industrials, energy, oil and gas, and healthcare all showing good performance so far. And so even though we fell a little bit here today on the S&P down to 51.17, off 0.2%, still look to be in this tight parabolic channel. However, there has been a bit of a rotation going on underneath the hood this week. You can see that again today with oil and gas, aerospace, defense, energy stocks, again at the top of the sector list here, and some of the worst performing sectors today: internet, tech, discretionary, communications, and semis, all finishing lower. And we can see that in my sector trends table indicator as well. Now I've got the NASDAQ, consumer discretionary, growth versus value, high yield bonds, momentum, and growth factors, all trading below their 20-day moving averages. And we've just flipped on volatility and bond yields, back to uptrending, along with oil, energy across the board, and other commodity related sectors waking up as well. And just quickly before we move on with a daily review, I want to tell you guys about my latest indicator called Shareholder Yield. And like a lot of my custom indicators, which you can check out on my website, clickcapital.io, Shareholder Yield is also a first to trading view. And some of you may already know about this relatively new and modern day way of looking at how good a company returns cash to investors. So we all know what dividend yield is. However, shareholder yield takes it 2 steps further. It shows you how much money shareholders receive from a company in the form of cash dividends, net stock repurchases, and debt reduction. And so it's been proven over time that companies that return cash to shareholders in the form of dividends, by buying back their stock and paying down debt, tend to deliver better returns than companies that don't do that stuff. And that's been proven true by probably the king of factor investing, Jim O'Shaughnessy, a long-time fund manager, and he's kind of a pioneer in quantitative factor investing. Actually comes from old money. His grandfather had one of the largest oil companies in the world, who did give away over 95% of his wealth, but left behind, I think it was something like $100 million back in the 1970s, and he dedicated his career to studying the stock market and what works, and actually wrote a great book on the subject I highly recommend called What Works on Wall Street, where he lays out in simple ways factors and simple systems that beat the market. And he's not only done a great job at managing his family's wealth, he's turned it into an asset management company that's very innovative and leading in its field. And so he did a huge backtest on shareholder yield and basically found over rolling 3-year periods in the US stock market, the top 10% shareholder yield companies beat other large stocks 81% of the time by an average of 3.24% a year. And looking at rolling 10-year periods, you would have beaten the market 97% of the time. And that might not sound like a lot, however, that accumulates in the long run. As we can see here from this 17-year backtest, the shareholder yield investment strategy delivered a total return of almost 1,200%. Versus the S&P's 131%. And it's not just US stocks. Shareholder yield has been found to deliver outperformance in stock markets around the world and even within sectors themselves. Here's a backtest looking at shareholder yield within gold miners. Huge sample from 1974 to 2020. Equal weight returns for the mining industry was 6.79% per year, whereas the high shareholder yield bucket was 11.61% per year. And again, that might not sound like a huge outperformance to you. However, it's more than 80% higher than equal weight. And that really compounds over the long run. And so I've managed to code up the shareholder yield indicator on TradingView. And like I said, it's the first one on TradingView. No one else has got it. And how I've coded it is if it's green, that means good. It's above 5%. If it's orange, like it is here on Apple, 3.78%. That's average between 1 and 5. However, if it's negative, like it is here on MicroStrategy, it'll show as red, and that's a negative shareholder yield. And why it's negative is because they don't pay a dividend. They're issuing more stock. So that's the opposite of buying back shares, and they're increasing their debt to buy Bitcoin. So in the long run, those activities have proved negative returns for shareholders, whereas a company like General Motors has a good shareholder yield of 12.45%. That's because they pay a dividend, they're buying back stock and reducing their debt, all of which are good for shareholders. And we can see with that recent increase in shareholder yield, so has the stock price. And I've also just updated my other fundamental indicators. For better visualization and easy to interpret, stock fair value, again, will show green if the stock's undervalued. Business quality score, green for good, orange for average, red for bad, and same with stock crash risk. And so these are all unique fundamental indicators that you won't find anywhere else. And instead of spending hours poring over financial statements and balance sheets, you can come and just use these indicators for a quick and easy visualization of whether the stock is good or not. And so if you've already purchased my all indicator package, shareholder yield will be added to your account over the next 24 hours. So just come back tomorrow, restart your TradingView, and you'll see it there, along with the latest versions of my new fundamental indicators. And I've got some more cool ones coming next week I'm excited to share with you guys. And so if you don't have them already, stick around because in a little over a week, I'm going to do an Easter special offering all my indicators for a good discount for 1 week only. And these are indicators I use to manage all my own accounts. And so I'm always working on improving them as I want them to be the best custom indicators that you can find anywhere online. Okay, just getting back on with the review. Like I said, the S&P 500 still in this parabolic uptrend. Another small range day today. We've got the Fed meeting coming on Wednesday, in which the market's pricing 99% probability they're going to stay on hold, like they're expected to do in May as well. We are seeing a little bit of increasing probabilities that they could stay on hold on June because of these hot inflation prints we've been getting. So we know they're pretty much staying on hold for a couple of months here. More importantly, we'll be looking to Fed speak, the language J. Powell uses, and the market really looks to see if he's becoming more hawkish, which means he's willing to stay on hold for longer, or more dovish, in which he's continuing to talk about the 2% inflation target doesn't really matter anymore, and indicating to the market he still would like to go ahead and cut in June, which I think he really wants to do. I think he'd love to get 2 cuts in before the election. And so maybe that's why we got a little spike in VIX today, getting above 15.5 before pulling back, and a little bit of a bump up in volatility risk premium. That's the implied volatility above realized, and a continued move higher in bond yields, which we saw a bit of an uptick this week. The 2-year up a healthy 25 basis points this week, 5 green candles. Same deal with the 10-year as well, popping up above 4.3. Dollar's kind of holding ground there, and we've had a little bit of a breakout in crude as well. So the stock market's doing pretty well to hold up in the face of all that, especially that hotter than expected CPI print we got on Tuesday. However, we're continuing to get a little mixed data. We've got consumer sentiment today coming in a bit lower than expected. That's basically a survey of consumers, how they're feeling, their expectations, their income costs, how they view the economy. And there's the print today, coming in a little lower than expected, 76.5. And just looking on the 1-year chart, even though it's been uptrending for the last year, consumers are feeling better now than they did a year ago. And it's actually near 2-year highs. Just going out to a 5-year chart, still well below where consumers were feeling in late 2019 when the sentiment survey was around 100. And just zooming out further again to a 10-year chart, we can see it was pretty much between 90 and 100 all the way up till COVID, and then consumer sentiment just really came off and hasn't made a full recovery. And that's a bit of a divergence in the economy because we've got stock markets and property markets still at all-time highs, whereas a lot of consumers are not feeling like their situation is at all-time highs. And so the sector that's been ripping the most this year, semiconductors, actually could be putting in a bit of a reversal formation. When looking at a weekly chart, which we can see here, starting to look like what we call an evening star formation. These 3 candles here, we rally up, the market continues rallying, and it kind of sells down, creates a bit of a doji, and then this week we've traded down again, lower highs, lower lows. You can see some of my reversal signals are starting to fire off, indicating the market is likely a bit exhausted here. And just switching over to the daily time frame on its biggest holding, Nvidia, still got that big bearish engulfing candle that could be playing out. For that to be unconfirmed, we need to close above that candle's high. However, this could be a bit of a topping formation. We can see a bit of a bearish divergence on my DSI, indicating momentum's stalling out a little bit here. And this is really the stock holding up the overall market, because like I said, we've got Apple in a clear downtrend, trying to find support, and what used to be the hottest stock, Tesla, even in a more pronounced downtrend than Apple, and it looks to have just lost some support as well. Percentage-wise, one of the biggest gainers this year, Supermicro, could be potentially topping out as well. We've got a big bearish divergence. Momentum's clearly stalled a bit, finished this week down, and AMD as well. Bit of a sharp pullback this week after we got that shooting star last Friday. And just looking at the Qs, sitting right on their 50-day VWAP already here. Was the weakest performing indice today. And if we see Nvidia and semiconductors lose their 50-day VWAP, then that's likely to roll over into a bigger correction for the Nasdaq as well. However, there's still many bulls in the room. Even got Goldman saying the Nvidia-led AI boom will eventually spread to 3 other areas of the stock market, and kind of a halo effect of what's going on with Nvidia, which you could think of like the picks and shovels of the AI boom, just like Cisco was in the internet boom of the late 90s. And so Goldman's saying the next sector that could benefit from this AI boom could be AI infrastructure. And that's companies like data center REITs, which have seen a huge explosion because all these servers and chips have to be housed in secure facilities. They use a lot of power. Hardware and equipment companies, security software stocks, and utility companies. They also expect AI enablers to benefit, software and IT services, and then finally AI productivity gains, where software services, commercial and professional services have the largest potential earnings boost from widespread AI adoption. Even saying companies like Walmart and Costco could benefit from AI, and it's true, pretty much every company can benefit from integrating AI, at least into their back office systems, and better data analytics to drive decisions and things like that. However, there's always 2 sides to a coin. That's why I always try and present bullish and bearish arguments for you guys here on the channel and let you decide. And we've got one strategist saying S&P 500 is bizarrely overvalued and could crash 49% as a recession sets in. And that would truly be against the consensus and election year seasonality. That's B. Riley's wealth chief strategist, flagging market and economic indicators that were flashing red, pointing to the S&P's historically high price to earnings ratio, unusually low dividend yield, elevated trading range, and infeasible priced in earnings growth. He also pointed to 180% plus reading on the Buffett indicator, which looks at the US's market cap versus its GDP. That's an all-time record. And along with other indicators like the inverted bond yield curve, if the economy doesn't go into recession in the next year or 2, it would truly be different this time. Even Goldman Sachs advising investors to buy cheap portfolio insurance in the form of near-term VIX calls, which is normally a losing trade full of decay. Unless you absolutely nail the timing on them, it's very hard to make money, especially with out-of-the-money VIX call options. However, the VIX has been low for a while, won't stay there all year. We've already got a bit of a steepening in the VIX term structure, with the VIX 6-month index almost 4 points above the VIX 30, which isn't much in points term. However, percentage terms, because we are at a low VIX, it's about 30% higher. And so it's normally in a state of contango, where we go higher the further you go out. And that's basically because the VIX is much more likely to spike at some point in the next 6 months than it is in the next 30 days. So there's a natural inbuilt premium. However, that's a bit more steeper than usual because in a little over 6 months, it'll be trading in October on the November expiry, and the market is pricing in a bit of volatility going into the US presidential election. So the curve's likely to steepen further over the next month or 2, basically meaning if you want to buy insurance expiring after the US presidential election, you will have to pay up for that. We've got another big shift in financial markets not a lot of people are aware of. That's basically the second most important central bank in the world, the BOJ, Bank of Japan, which has artificially kept rates low for decades now. Could be shaking things up in a big way by scrapping negative rates. In a sign they could be worried about inflation as well. And this could have ripple effects around global bond markets, since Japan's the only major central bank that hasn't hiked borrowing costs during the current cycle. They've kept their main policy rate at minus 0.1%, going on 8 years now. Also doing what's known as yield curve control for years to keep their monetary policy loose, trying to stimulate the economy basically with cheap capital, to the point that interest rates even negative there. So basically forcing you to take risk, put your money to work. That's also a cultural thing, as Japanese really like to save money. So they really have to go hard the other way. However, that could be changing now. And the BOJ is actually meeting a day before the Fed on this coming Tuesday, which they could lift rates to zero via a 10 basis point move. However, if we got 20 basis points, that could upset the picture a little bit for markets. And we can see that in the Japanese 10-year government bond yield, moving up strongly this week, now at 0.78%, along with a bit of a pullback in Japanese stocks these last 2 weeks, in which their market has been one of the best performing international stock markets for about half a year now. So next week could get interesting with the BOJ on Tuesday, the Fed on Wednesday. If they were both to come out more hawkish than expected, we may see the S&P 500 have its overdue pullback and lose its 50-day VWAP, currently at 50.29, which could happen as we've already got Treasury yields moving up higher into that. Maybe the market is expecting Jay to soften his hawkish tone a little bit. And regardless of what the Federal Reserve does, who sets monetary policy, that's interest rates, another big effect on the bond market and yields is that from the federal government, who sets fiscal policy, that is spending, at which they're pretty good at. Just last month alone, they spent more than double what they took in revenue. And this is a long-term structural problem that could eventually break one of the largest markets in the world for US bonds, especially if the debt to GDP ratio keeps going up and countries that have traditionally bought a lot of US Treasuries like China and Japan continue to back away, especially if they can earn a higher yield in their own backyard without taking on currency risk, not to mention the long-term pursuit of de-dollarization. And so the last thing the Fed and Jay Powell needs, along with the Biden administration, is inflation ticking back up. So it'll be interesting to hear what he has to say this coming Wednesday about all that. Not to mention a big driver of inflation, oil, finishing up more than 4% for the week. Also the CEO, one of the world's largest shipping companies, Hapag-Lloyd, saying that inventories around the world are getting depleted. He's seen a recovery after Chinese New Year. Ongoing Houthi attacks in the Red Sea and the Panama Canal drought is forcing US companies to pay more for their ocean freight, with rates on key routes up 75% to 150% year to date. That is huge and likely hasn't filtered through to the prices of products and services we pay yet, as a lot of them are still on a ship coming towards us, and so that's really inflationary stuff. We've also got other things like the threat of labour strikes at the East Coast and Gulf Coast ports in the fall, and he also said he's seen an improved view on trade for the rest of this year. So we got shipping prices up, demand holding up, if not coming back, along with depleted inventories and the potential of China coming back. That could all be really inflationary stuff that could upset the narrative in markets. We've also got the Bloomberg Commodity Index climbing to its highest level in a year, on the back of commodities like cocoa hitting another record, making the cost of our chocolate going higher. And there's a few factors causing this. Most notably, the weather pattern known as El Nino, causing extremely wet conditions in West Africa, causing fungal disease in cocoa crops, which is hampering production and harvesting. And there's a look at the parabolic rip and cocoa, trading higher like a crypto meme stock. Saw some other good moves in copper this week, which is considered a growth commodity. Market could be betting on a bit of a rebound in China here. There's a look at crude, just sitting at $81 a barrel. Nice move up in silver this week. You can see a bit of momentum back in this market, and gold as well, not sitting too far below all-time highs here at $21.59 an ounce, and another strong rip in the agricultural fund. But we've still got other key commodities like wheat and corn relatively weak. However, if they were to join the party, that's really going to get food prices moving higher in the months ahead. And just moving on to my key story today, cannabis. Having a great day. The most liquid ETF, MSOS, up almost 15% in the regular session, trading higher in post-market as I speak, on really good strong volume here. And like I said a couple of days ago, it looked to have found support in the support zone. Had some bullish reversal signals, and technically speaking, it's just played out beautifully. As many of my long-time regular viewers know, I'm long this ETF. It was my top pick for this year that I gave out on my last video on the last trading day of last year in 2023. We're up about 26-27% year to date, and whilst that sounds like a lot for a normal stock or sector, I still think it could be just the beginning, and it could have a lot more further to run. So one of the basic tenets of technical analysis is markets mostly go through a 4-stage kind of cycle, with the first stage being accumulation, where prices pretty much bottom, find support, big money accumulates. Then we go into stage 2, which is the advance. prices break out, people jump on board, then investor sentiment, optimism, participation, people buying call options, all that good stuff usually happens around the peak, along with media mentions, and typically insiders selling as well. Then we go into the stage 3, which is distribution. Big money's offloading, selling, getting out. Then stage 4 is the inevitable decline, which we had a beauty in the cannabis sector this last couple of years. So what I think now, for the last half a year, we've been back in stage 1, accumulation, and just going down to the weekly chart, we can see that with these big explosive momentum thrusts off the low on big volume, pullback, held, thrusting up again, and I think we've just done that again this week here. And there we are, back on the daily chart, currently trading above the 50-day VWAP after hours as I speak. So that's the technicals, which I think look good. We could be potentially going into that stage 2 advance. Just looking at the fundamentals, they've been good these last few weeks as well. Notably from Europe's largest economy, Germany, making a step in the right direction towards federal legalization of cannabis and kind of paving the way for Europe, and maybe sending a bit of a wake-up call to American political leaders that they're falling behind the curve on this topic and missing out on important tax revenue, and doing the right thing and legalizing and regulating a product that more than 80% of Americans want legalized and regulated. And so a few weeks after that happened in Germany, we actually got the US government, basically for the first time in history, with their federal scientists joining the Department of Health and Human Services and recommending easing restrictions on marijuana, and finally admitting that cannabis may have medical uses and, surprise surprise, is less likely to cause harm than drugs like heroin, in which cannabis is currently in the same classification of Schedule 1 with heroin. And you don't have to be a scientist to realise that is true, but it's good to see the government finally admitting that. Not only that, a couple of days ago we had the Health and Human Services Secretary defending the FDA's review of cannabis science and its recommendation to loosen federal marijuana restrictions during a Thursday hearing on Capitol Hill. But what really got the market for cannabis stocks moving today was a tweet from a hedge fund manager, Dougie Cass of Seabreeze Capital Partners, who's been closely following the subject, and he tweeted out this morning, "We have learned yesterday that the US Drug Enforcement Administration, that's the DEA, who we're all waiting on, will shortly approve a rescheduling of cannabis to Schedule 3, and that the biggest legal hurdle, an international treaty to which the US is a signatory, has been resolved favourably." By means of background, the same sources informed us several days before the rescheduling announcement in late August that the legislative winds were swirling in Washington, and that proved to be right. So he's basically sharing his inside information with the market here. That's why we got that strong rip today, as we could very well hear the DEA come out next week with the big announcement we've all been waiting months for, and that could open the doors for more important things, like the removal of the 280E tax rule. Basically, cannabis businesses can't claim expenses as deductions, which is a huge disadvantage. They can't access federally insured banking and good finance terms. Another big hurdle they've been dealing with Safer Banking Act, and then the real big one, making it federally legal so then big institutional money can flood into the space, of which they really want to do, and they're just not able to right now. Also just heard Vice President Kamala Harris arguing in the same direction, urging the DEA to immediately reschedule cannabis to a lower risk category. And Joe Biden's been talking about this, and as one of his campaign promises that I think he wants to make good on before the election. So all angles of the government want this done, just waiting on the DEA to do it, which they are expected to do. It'd be a huge upset if they didn't, and they would face a huge amount of criticism, but that could be happening in the days, if not weeks ahead. And so in addition to the Cannabis ETF MSOS, there's some other ways anybody can get exposure to the space. That's directly investing in cannabis companies, most of which trade over the counter on the OTC exchange, and just looking at US companies with the largest revenue. And these are already sizable companies, like Curaleaf, their last quarterly sales coming in $345 million, Trulieve, Green Thumb, Verano, Crisco, and their revenues pretty much correlate with their market caps on the leaderboard, but these are still small companies, relatively speaking, with the top 41 companies only having a total market cap of 20 billion. And just in comparison, Nvidia's market cap changes in value by that much in just an hour. And so the flood of institutional capital could blow this out to multiples in the months and year or two ahead. And these companies here will be able to uplist from OTC onto the big board, NYSE and NASDAQ, and open the floodgates to institutional capital. That's why they had some big rips today, with a few of them up over 10, 15, 20%. And that's why I think this sector fundamentally and technically has room to run. And it's amazing these companies are about to survive, given the huge challenges and hurdles they've been faced with, not to mention competing with the black market, who don't have to pay all these extra taxes. And so I think this is still an asymmetric bet to the upside, much more room to run than there is downside. And personally speaking, I've been long this one for quite a while, and I've recently just turned it into a bit of a spread trade by going short Philip Morris, as I wanted to take out a bit of market risk, and long term I like the idea of being long cannabis, short tobacco, especially since Philip Morris has a market cap 146 billion, which, like I just showed you, is more than 7 times the value of the entire cannabis sector. I think it's inevitable one day the cannabis sector will be multiples higher than that of tobacco and potentially alcohol as well, since it has such more widespread uses and applications. And who knows, that could happen in the next couple of years. So this is more of a long-term spread trade for me. And of course, with cannabis, the most volatile one, that's the one really driving the returns on this spread. I'm just taking out a bit of market risk by being short Philip Morris. And I think tobacco is going to continue its structural secular decline. Even countries like where I live in New Zealand are implementing new laws to phase out tobacco. So young people turning 18 can no longer buy it, and we plan on phasing it out of our society over the coming years, whilst the acceptance of cannabis is growing more and more as well. And just moving on with the review, we've still got the Fear and Greed Index stuck in the greed zone. The bulls are really sticky on this rally. Insiders still selling way more shares than they're buying. There's a look at the options market. Still a lot of call option buys. Nvidia still well out in the lead. Other hot stocks, MicroStrategy, Super Micro, still a lot of activity. And wasn't a huge day for a triple witching. Only 44.5 million contracts traded. Still really lopsided, 57% calls. There's a look at Bitcoin. Actually had a big dip overnight down to 65,500 before it's recovered, just sitting below all-time highs there. China had a little bit of a pullback today, and there's the clean energy ETF dipping down to multi-year lows, and I've been adding to my long position in this sector as well. I think it's good value for the long term, even though we may have not found a bottom just yet. International stock indices all finished a little higher for the week, and there's that move up in copper versus gold, which has been oscillating beautifully for a few months now. We may actually get a bit of a breakout out of this range next week, and that's normally a good sign for global growth prospects. Inflation expectations still on a short-term uptrend here. Jay Powell's going to have a hard sell if he's going to start cutting rates in a few months. But consumer discretionary just lost its 50-day VWAP today. Energy stocks performing the best, maybe getting a little stretched here in the short term. Worst performing factor today was momentum, and overall mega cap tech a little weak. Microsoft pulling back from all-time highs yesterday. Nvidia still consolidating, and a bit of a pullback in Amazon, Alphabet, and Meta. With Tesla just kind of holding ground on a small range day, and mixed performances in these other hot stocks we're tracking here. Market kind of in a pullback, but not too bad just yet, and financials still hanging in there pretty good. All right, guys, there we are for the third week of March as we approach the end of Q1. You can see the market still holding this parabolic channel, even though we've got a little bit of a pullback going on underneath the surface on some growth sectors, bit of a rotation into oil and energy. We've got volatility in yields starting to trend back up, and then, like I said, we've got the BOJ on Tuesday and the Fed on Wednesday, and so the language coming out of them could get things moving. Maybe that's why we got VIX closing up higher, which we normally don't get on a Friday. Other than that, that's all I've got for you this week. I hope you found some value in this video. If you did, please click that like button, and you're welcome to share your thoughts on the market in the comment section below this video. I respond to everyone, so I'm interested to hear what you think about this market and anything I've talked about. Thanks very much for sticking with Click Capital, and I'll see you again next week. Cheers.